Picture this. You put down 20 lakh to book a 2 crore flat from Miranandani Builders in Mumbai. The rest is on loan. Or let us take another example. You lock in balcony seats for 4,000 each for a Maylor Swift concert at Triumph Towers 6 months away. But here's the twist. In each case, you have already committed to a price today for something you will get in future, which means you have quietly stepped into the futures and options world. Specifically, you have gone long on a future with a very real underlying. You didn't call your broker, you didn't log into a trading app, but you have already started playing the same game. Welcome to Financial Flywheel, where we aspire to design, nurture, and run your financial flywheel. Today's discussion will be a single point agenda. Unpack the terse term called futures in a way that makes it easy to connect with and understand. No jargon, just clarity. Hmm, this is interesting. I said that we did buy a flat for 2 crores in Miranandani. We booked a house which is facing the garden, and the bankers would say that you need to give us at least 10% of your money for the cost of the property, which is around 20 lakh rupees, and the remaining payment will come from the bank, which is about 1.8 crore rupees. Okay, while there is a lot of numbers in this slide, it is important we go through each and every one of them to get a better grasp of the uh, futures and options concept that is underlying over here. The entire discussion will be based on futures, but subsequently, when we touch upon options with the same example, the points will become even more clear. How much of the flat is yours on day one? You only own the part you have paid for, which is 20 lakh down payment. That's 10% of the flat's price. So the other 90% belongs to the bank until you repay them. Okay, now step two, what happens if the prices go up by 10%? The happy case scenario of price going up means that the new flat price is no longer 2 crores, it is 2.2 crores. Your loan with the bank still is retained at 1.8 crores. So your new equity is 20 lakh you have paid down payment. Another 2.2 crores minus 2 crores, another 20 lakhs. So great, you have now 40 lakhs. So what you notice is your equity went directly from 20 lakhs to 40 lakhs. That's a 100% gain on your investment because you used leverage. Okay, step three, the topic that usually most investors don't ask, unfortunately. What happens if the prices go down by 10%? Well, the new flat price of Miranandani would be, say, 2 crores minus 10%, which is about 1.8 crores. Our loan is still 1.8 crores, which means our entire equity of 20 lakhs has disappeared. So, what might happen now is the bankers might start requesting for a collateral, a margin amount. So, we have found a way in which the entire experience of buying a flat through a home loan actually is inadvertently touching upon the concept of futures. Why is this a futures position? You have locked in the price of a future asset the flat using a small upfront payment, which is called margin, controlling a much larger asset. So think about it. You just paid 10%, but landed up owning the entire property. And if the property prices were to go up, it is not that the profit will be shared by the bank. The entire profit belongs to you. That is why it is called a control of a larger asset. Okay. Price moves affect your equity far more dramatically than if you had bought it outright. So, in other words, suppose you had put 2 crores to acquire this property. If the price movement were to take place by 10%, upwards or downwards, you still own the flat and you are not greatly impacted. However, in the case of a margin or a leveraged position, in this particular case, we noticed that when the market moved against you, lost 10%, then the entire capital is lost. Okay, so now let us look at what happened in case you, instead of buying a Miranandani flat, thought that, okay, let me invest in Maylor Swift's concert, which is going to take place in Triumph Towers another 6 months from now. Okay, this setup is also exactly like a futures call. Assume that you needed 4 tickets for you and your friends. You lock in 4 balcony tickets at $500 each for a show 6 months from now. Now the total notional value would be 500 into 4, which is $2,000. The platform lets you reserve, say, with a 10% deposit. So that would be 10% of $2,000, which is $200. And the balance you can pay it during the time of the concert, say. Now let us look at a happy case scenario. Say there is a demand for the concert, and so in the secondary market, the price goes to, say, $600 per ticket. So what has happened is the $500 is now worth $600, which means we had 4 tickets, each one gained by $100 or $400 total. So our equity, since we had deposited 10%, which is $200, is now equivalent to 200 plus 400, this additional gain, and hence it is now $600. So return on our $200 margin landed up to be $600, though the price of the ticket only rose by 20%. Why? 500 is the cost, divided by 20 into 100 is 100, which is 20% of 500 is 100. So 500 plus 100 is $600 is the new price, correct? So this is leverage in action. Now, what would happen in case the demand were to fade? In the secondary market, let us say the price now dropped to $400. So your loss per ticket is 500 minus 400, which is 100. So the total loss is 400. We had given an initial deposit of 200. Now the total deposit is 400. So total loss is 400, sorry. So the net is minus 200. So which means that the platform where we had bought the tickets would be very unhappy and would want at least 200 to nullify the loss. So there would be a margin call of $200. Okay, so why is this like a futures position? You controlled $2,000 of asset with an exposure of only $200. Small price movements of plus or minus 20% creates big change in the equity value. Margin calls happen when losses eat through our deposit. Same mechanics as futures, and in this context we understood how a future price is fixed, what is meant by leverage exposure, mark to market of gains and losses, and margin discipline. Margin discipline is that discipline wherein we always make sure that the margin amount is always there. So what we would have done in this scenario would be that the moment we see that that the margin amount is depleting, we would immediately push funds into the application so that the application platform does not close our position inadvertently. Okay, so along with the concept of futures, we also learned about the concept of a discipline in the context of future. Now, another concept you are going to learn, which is a concept called probability distribution function, something which we touched upon earlier in the fundamentals. But it looks like a Napoleon's cap, but this is a cap that we definitely need to wear in case we have to be successful in the domain of futures and options. Okay, now this hypothetical example of Miranandani Builders, let us assume we plotted this graph. In a couple of slides, we will come up with a theoretical analysis of how this graph was plotted. But let us just assume that this graph was placed in front of us even before we decided to buy the flat. What we would notice is that the 20% down payment that the bankers are asking, uh, which is around 20 lakhs, if the property were to depreciate by more than 3 sigma, then the chances of our initial capital to be wiped off, our equity to be wiped off, so that the banker will ask for funds as collateral is possible. So this is a very low probability scenario wherein the chance of the initial deposit being wiped out. In this particular hypothetical example, of course. And let us say our target was, say, about 20 lakhs. Then, even a 1 sigma, that is a most likely scenario in the context of a probability distribution function, is between 1 sigma. So, if we were to wear the thinking cap, then we notice that 1 sigma is not very far off and the likelihood is much higher. So, we are happy to invest in Miranandani flat. Okay, now let us look at the other example. Probability distribution function would look like. You notice over here that even in this hypothetical example of say 6 months of price movement data of Maylor Swift tickets, we notice that if there is a 10% downside move is let us say coming to 1 sigma, then that is enough to wipe out our deposit. So in the earlier example, for us to wipe out our entire 10% down payment for Miranandani, for that the market had to drop more than 3 sigma, whereas in the context of Maylor Swift tickets, even if the market were to drop by 1 sigma, our capital is lost. So what we learn over here is that certain aspects of the probability distribution function can greatly help us in determining what is a safer bet compared to the other. This mathematical modeling will help us greatly in the days to come when we actually take positions in futures and options, which actually we saw firsthand in this hypothetical example. Now, to summarize about the bell curve so far, what we have noticed is we first determine the mean with data. If we had the data, we have actually determined the mean. Then we tried to think in terms of a bell curve, and this hypothetical example, we had 6 months of historical data for each scenario. For the flat, we looked at how property prices in the part of Mumbai typically move month on month. For the concert tickets, we imagine how resale prices change for big international artists, show from date tickets are announced to event day, and specifically for Maylor Swift. We calculated an average price change over that 6 month window, and that way our mean was determined, which is the middle of the bell curve. Next, we measured how far prices likely swing away from the average. That typical swing, the average deviation, is called 1 sigma or 1 standard deviation. In our flat example, 1 sigma up means the property prices moved up by 10% or higher. 1 sigma down would mean about 2% lower than the mean. That's what we found in the context of property of Miranandani. From there, 2 sigma is simply twice that move, and 3 sigma is 3 times the move. This is standard probability distribution function mathematics. The further we go away from the center, the less likely it is for prices to land. In real life, irrespective of whichever be the underlying asset, 1 sigma might take a few weeks or months, 2 sigma might happen only once or twice in 6-month period, and 3 sigma swing that usually an unusual event. Something big has to change in the market or some news should come. Again, the time period that we are discussing over here is actually the time period that we are using for collecting the data. Since we have 6-month period data, we are talking about 6 months. In the real world, basing on the duration of the data, to that extent, the sigmas will get adjusted accordingly. And 3 sigma will come very rarely. It is actually in loose terms or in the commercial terms, it is called as a black swan event. The same thinking also applies for concert tickets, isn't it? 1 sigma might be a small bump in resale price, maybe the first way after the tickets sell out. 2 sigma could be after the hype spike that the artist's popularity actually really surges. 3 sigma may be a major last minute change, venues expanding or some big person is trying to visit the concert. No, these are the things. So what we should take away from here is 1 sigma events are common. We must plan for them. 2 sigma events are less frequent, but we need strategies ready. 3 sigma events are rare, but when they hit, we may make or break. Hence, it is a low probability, high impact scenario for which we must have some kind of a hedge available. That is why futures traders must think in probabilities and not certainties, because the market's next move could be 1 sigma or it could be 3. What we have done with the bell curve here is purely price-based probability. What price levels are most likely? Plus or minus 1 sigma, plus or minus 2 sigma, plus or minus 3 sigma. How likely it is to hit each range is the probability distribution. Note, it does not tell us those price levels when it will be reached. In this example, all we know is the duration was for a 6-month period. So within that 6 months, anytime it can occur. Okay. So how do we draw a parallel with that of the actual futures and then subsequently options? We will see when we actually come to that topic of taking a sample futures either from the US market or from the Indian market and India market and analyzing. Now let us conclude. While we have all been customers to experiences of the nature of buying a property by taking a loan or a concert ticket booking, we might never have considered the problem to be that of a probability distribution function. However, as a futures and options trader, we would need to take cognizance of positions in the market based on the underlying asset. In this case, the underlying asset was that of real estate in Mumbai area, where we had the Miranandani apartment. Or let us say the underlying asset could be Maylor Swift concert ticketing. Was there an opportunity to sell the property or the ticket before we owned? No. However, such more scenarios will also open up in the context of futures and options. We will anyhow cover that part subsequently, where it is said that we are shorting the position. Hope this video helped nudge in helping us think in terms of probability distribution function and also brought out the aspect of leverage and margin. As always, thank you for your time, guys. Good luck for all that you're doing. Until we meet next, bye for now. Thank you.